This series has been thoughtfully curated to cover the full spectrum of FEMA-related topics. It is designed not just as a lecture series, but a practical learning platform for members who want to deepen their understanding and strengthen their advisory capabilities. With this, may I ask everybody to raise for the ICAI motto?
Yaesha sukteshu jagrati Yaesha sukteshu jagrati Kamam 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 pursho nirvimanaha Tadeva shukram tad brahma Tadeva mritamujjate Tasmin lokaha shitaha Sarve tadunatyati kaschan Etadvaita
Thank you. We are especially privileged to begin this series with today's session on the overview of FEMA, definitions, structure, and interpretations, to be delivered by CA Shabbir Motorwala from Mumbai, whose expertise and experience will set the right tone for the entire series. We look forward to his insights and to the valuable perspective he brings to the important subject. I would also like to acknowledge the efforts of Team ICAI Ahmedabad branch, the speaker faculty, and our event partners for making this initiative possible. We hope this series will be enriching, interactive, and immensely useful to every participant. With this, let us begin today's session by lighting the lamp.
Thank you, Chairman ma'am. Friends, good morning. And we have 11 days series, and this formality is for the first day only. Just I'm clarifying, right? So you should not expect that every 11 days, every days of that is we will have these formalities. Respected faculty for the day, CA Shabbir Motorwala, respected RCM, immediate past treasurer of WIRC, CA Fenil Shah, Vice Chairman of ICAI Ahmedabad, CA Samir Chaudhary, Coordinator for the day, and my dear friend, CA Charmi Shah. One of the expert in this series, I can say, the topic FEMA, and coordinator of this event, CA Jai Joshi. Respected seniors, our ICAI's internal auditor and senior, CA Dharmesh Parikh sir, CA Nalin Thakkar sir, and other seniors. Friends, I feel privileged to launch this FEMA series. Generally, such kind of series, it may be an India series or an income tax series or a FEMA series. Generally, it was a trend that it was a launch in the month of December when people are rushing for the CPE hours. But this year, if you see the brochures, our goal is unlocking the global alpha for CAs. So we would like to have the global opportunity, cross-border transactions opportunity for the chartered accountants. So that's why from the month of April, we have started various sessions particularly focusing on the global opportunity. On the 4th April, we had a deliberative sessions for 6 hours for the opportunities in audit, taxation and bookkeeping in the US. This 11-day series very well crafted by Charmi ma'am, Jai sir and Soumya Sheth, to keep in the mind that each and every participants can be in his routine, they can attend their office in time, and they can come in the morning to learn this new topic, or I can say brush up their knowledge in related to this topic. Friends, we have invited faculties from all over India. On the last day also, we are going to have the detailed panel discussions where we are going to have 4 to 5 faculties as a panelist, and whatever you have learned during this 10 days, that moderator will ask question answer pertains to that to the panelist, and you can also ask question answers on the last day. Again, for the respective topic, if you want to ask the question, feel free to connect to the faculty immediately on the completion of the topic. Friends, this again I am mentioning that this year branch is focusing along with the traditional area, global opportunity. In short time, we are going to have the sessions on the opportunity for the Australia, opportunity for the Gulf countries, opportunities for the Europe countries. So I want you to keep, eyes on the WhatsApp coming from the branch, or I can say email coming from the branch. One more thing, first time in the history of ICAI, I can say, specifically focusing the senior citizens, because they want to learn the AI, but they don't want to go for a certificate course for the long duration of 18 hours or 20 hours. So very well crafted by our RCM sir, CA Anil Shah sir. On 4th and 5th May, we are going to have the workshop for the senior CAs, mentioning specifically having age more than 50, specifically to give the guidance about the AI and basic how to use the AI and which kind of tools are available, which can help you out in your routine practice. Again, as a chairman of ICAI branch, Ahmedabad branch, which is the largest branch of the largest region of largest accounting body of ICAI, I urge you and request you, all of you, to take the maximum benefit of this series, and any kind of, such topics you want that this kind of session should be there at the branch, feel free to connect me or any of the managing committee member. We will love to host this kind of topic. We are least concerned with the number of the participants. If 2 participants are sitting, but if we have to invite the faculty from, any part of the India, we are happy to host you for the knowledge upgradation. Once again, thanks a lot. One small request and the questions, or I can say request or the request from my side. Today we are sitting in the auditorium. We are having 120 participants. We have a classroom also having that kind of capacity. Just I want to take the feedback from you, because this will be a learning session, not the seminar. So if you want to make notes or something like that, so if today you are not comfortable, then please let me know. I will again come, or I will be sitting over here only up to the end of the sessions. So we may shift from tomorrow for remaining days to the classroom. So where you can have a bench and you can, have that, writing stuff and other stuff. So I will take the feedback at the last, and based on your feedback, we will continue the sessions from tomorrow. Once again, thanks a lot. Thank you. I request Charmi ma'am to continue.
Thank you, Rinkesh bhai. Thank you once again for giving us the opportunity to explore areas which are niche and are enchanting. Now I would request CF Anil Shah to please share some important, some experience of
Thanks,
his.
Shabi. I'll be very crisp because I am also excited to learn FEMA and cannot waste a single minute. But I can say again on behalf of Chairman Sir that whenever we meet, Rinkesh bhai always has a desire कि कहीं अलग करबू है. Right. So I would also request you all that you all might be having some kind of idea. Like when we were sitting, we also got one idea that we can do some sessions on foreign treaties interpretation also. But then again, I raised a question, ke ketla avse? Then he gave the same answer, ke even if speaker is there and one participant is there, right, we will do the program. So just on behalf of Rinkesh Bhai and the whole team, I would request, no idea, any unique idea, you bring it, right, and that thing will be executed. But nothing more. Thank you. Thanks.
Thank you so much, Vanil Bhai. I mean, thank you so much for such a short and sweet, appreciation words from you. May I now request Samir Bhai to please share his thoughts on this?
Thank you, Charmi Ben. First of all, I would like to compliment Rinkesh Bhai for articulating such a nice series. You know, talking about all the compliance part, like TDS, income tax, GST, બધા expert હોઈએ આપણે બધા. જબ આ બધી વાત આવે ને RBI, FEMA ની બધી વાત આવે તો બધા મુશ્કેલી પડે, including me. It's not a new thing. So we can see here the fleet of people sitting over here. From junior to respected senior members are here. Even Dharmesh sir is there, that we can see. Nalin sir is there, many more seniors are there. So it's a compliment to chairman and the whole committee that they are articulating such a things with their 11-day series. उसमें भी ये ध्यान रखें Saturday Sunday नहीं होना चाहिए. So we can even enjoy life, work-life balance on that part. So great and happy learning to all. And thank you, Shabbir sir, for joining us.
Thank you, Samir Bhai. I think, and a very big thank you to the participants, like, coming in such a large number, especially on the working mornings and looking at the participation. I really feel happy. And it gives an assurance that still, these are the areas which are niche, but are still interested to most of the members. Thank you so much. Now, I would like to speak something about Shabbir Bhai. So I think Shabbir Bhai in this forum does not need any introduction. He is known by most of us who are interested in this topic. But just for the basics, just to know him better, Shabbir Bhai is a partner in and head of corporate and international tax and advisory services at BSR and Company, Mumbai. With over 27 years of experience, including most of the time with the firm, he specializes in corporate tax, foreign exchange laws, international taxation, and tax TT provisions. He advises multinational and large Indian clients in sectors like pharma, automobiles, consumers, and so on. And he's a regular speaker at ICAI, Bombay Chartered Accountants Society, CTC, and other professional forum. With this, I warmly invite Shabbir Bhai to this forum, and we are looking forward to your expertise, your knowledge sharing with us. Now I would invite CA Rinkesh, Vanil Bhai, and Samir Bhai to please present a memento to our eminent speaker today. Please welcome with a round of applause for our speaker. Thank you, sir.
Good morning, Ahmedabad. Good morning, louder. Good morning. Great. I hope you had a good breakfast. Let me start first by congratulating CA Rinkesh Bhai, Chairman, Vice Chairman Samir Bhai, Vanil Bhai, Regional Council Member, Course Coordinator Jay and Charmi for putting together one of the longest FEMA course in ICAI. And I was just wondering, where does this 11 series come from? Does it get influenced by the IPL and the 11 players that are in a cricket team? I don't know, sir. Next time, maybe you can think of an impact player rule as well. Because I think 11 is certainly short in terms of the number of topics that can be covered under FEMA. With that few words, today, friends, I'm privileged to speak to you overview on FEMA, definition, structure, and interpretation. So we'll look at how the FEMA era evolved from the old FERA. I think we have some senior professionals in the auditorium, and I'm sure they would have seen FERA. I have not seen FERA. I started practicing largely when FEMA came in. And we'll go through some of the structural provisions of FEMA, some of the sections, some of the important rules and regulation, some typical compounding, late submission fees. We'll look at import-export, current account transaction. We'll look at some important websites which are relevant from FEMA perspective. We'll look at some do's and don'ts from FEMA because all of us come primarily from a tax background. We are either audit specialists, tax specialists, either direct tax or indirect tax. So we typically try and apply those principles to FEMA, which may or may not work. And lastly, we will look out for things to watch out for. because there's a lot of development still to come on this topic, and time permitting, we'll have Q&A as well. So friends, prior to FEMA Act 1999, there was this Foreign Exchange Regulation Act, FERA as it call it, 1973. In fact, exchange control was not new to India. Exchange control was first introduced in 1939, and there was also a FERA Act of 1947. So 1973 Act was only a subsequent third level of control that came in. Now, what was the object of FERA? It was conservation of foreign exchange. What do you mean by conservation? Protect. Don't allow it to be spent. Earn as much as possible. And all acts were controlled and regulated by the RBI, and it was all notified and regulated under the Exchange Control Manual. It applied to Indian citizens in and outside India and foreign citizens in India. Unlike today, where we have free foreign exchange rate, in the FERA regime, most of the exchange rate was controlled by the RBI or dominated by the RBI or fixed by the RBI. It had very severe penal provisions, and it was criminal type of provision. So somebody could get arrested for not complying with the FEMA law. There was a presumption of mens rea. So if you violated FERA, it was assumed that you did it with a purpose to break the law. Even though the mistake can be inadvertent, there was no weightage given. It was assumed that you are doing it with a purpose to break the law. There were blanket powers of search, seizure, and imprisonment. So this was the regime, and it was known as a draconian regime. In fact, I remember one very senior professional from whom I have learned FEMA told me that that law was so complicated that even if somebody had to drink a water, let's say if drinking of water required permission, FERA said that you should obtain permission to drink water also. It was that type of a law. And then eventually, when India liberalized its FDI policy in 1991, that the government then conceptualized and introduced FEMA in 1999. And unlike FERA, the object of FEMA is facilitating external trade and payments and promoting development and maintenance of foreign exchange market. So unlike FERA, which is conservation, this is facilitating trade and payments and development of foreign exchange market. So it's a very civil law. Unlike the earlier law, which was criminal, severe, penal, this is a civil law. If you break the law, there are penalties. There is no imprisonment. And only specified transactions are fully regulated. Capital account transaction, that too primary. The concept of citizenship is no longer relevant. The FEMA applies based on the residency criteria. There are very restricted power of search and seizure. Now, here I would like to mention that while FEMA is largely administered by the RBI has no power of search and seizure. The entire power of search and seizure is with the Enforcement Directorate. So here we have to understand, and even within the Enforcement Directorate, the information they call from you is under 133(6) of the Income Tax Act. So there are no direct provisions even to call for information under FEMA. It is a voluntary declaration-based law. There is no presumption of mens rea. So if you break a law, if you make a mistake, you are supposed to explain to the authority whether it was inadvertent, whether it was venal, whether it was intentional, and they will decide and take the next step or decide the future course accordingly. Contravention definitely attracts penalty and fine, but not imprisonment, except in some cases. Then there is a compounding of contravention possible. So friends, compounding is not a new concept in FEMA. Compounding existed under the Income Tax Act. Compounding means that if you make a mistake, you go to the regulator, admit the contravention, and you pay a fine, which is much lower than the penalty. And now, over many, many years, the RBI realized that instead of compounding procedural delays, it is better to introduce late submission fees. And again, this late submission fee, this concept was borrowed from the Companies Act. Because largely in Companies Act, whenever you file a form late, you just pay the late fees, and it is either a monthly fee or a per day fee, and you move on in life. There is no need to give a hearing. There is no need to quantify. There is no need to go into a reason. So the late submission fee, we'll get into the details of it a little later, but it has simplified the FEMA practice quite a bit, So let's look at how FEMA is constructed. FEMA, the appointed date is 1st June 2000. The Act came on 1999. The rules and regulation were mostly notified in May 2000, and the appointed date or the date on which it became effective was 1st June 2000. And as we went through the aims of FEMA, so now in FEMA, there are only about 49 sections, and largely the Act is governed by rules and regulation. So under every section, either a rule has been notified by the government or a regulation has been notified by the RBI. So the thumb rule is that under FEMA, there are notifications, and the notifications are of the government. When government notifies it, in accordance with the power given by the Act, it is the rules. When RBI notifies something, it is the regulation. However, it has to be noted that whenever the government issues the rule, it has to consult the RBI. And when the RBI issues the regulation, it has to consult the government. So neither the rules, neither the regulation can be issued by anyone without consultation. And that's why, friends, if you see, there is sometimes a lot of delay in formalizing of policy, issue of press release, issue of notification, or bringing out the desired change, because there is a lot of correspondence that happens between the RBI and the government, which is primarily the Ministry of Finance. Now, also, over the years, there have been hundreds of notifications that have been issued. The current series of notification is in 400. So the first series was issued as FEMA 1, FEMA 2, FEMA 3, then FEMA 20, 20R, and now there are NDI notifications. So there has been a lot of change, and we have almost 400 plus notification. And they are generally, the notification is effective from the date of notification. Now, the RBI website, friends, if you go through it, rbi.org.in, it is one of the most comprehensive website, providing you almost everything that you need to practice. Generally, I personally feel there is not even a need to buy a book in FEMA. If you just go through the RBI website, it has everything. It has the rules, it has the regulations, it has the APDR circular, it has the master direction, it has the compounding orders, it has everything. Technically speaking, it is all free of cost available. There is no need to invest in a book. If you decide to buy a book, we'll tell you what to buy down the line. Now, on the RBI website, what is most important is the APDR series. AP stands for authorized person, which are bank and direction series. And the RBI issues them from time to time to announce changes, to guide them about particular provisions, to explain how the provisions have to be implemented to the bank. And then there is a master directions, which are updated periodically. Now, friends, what happened when FEMA came in? There were almost 100 plus circulars issued every year. So if you go to, let's say, 2000, 2001, 2001, 2, every year RBI issued 100 of circulars. And in about 5-7 years, there were 700 circulars. So if you have to research any topic, you have to go through almost 700 circulars to find out what is the latest position. And then somebody represented to the RBI that instead of simplifying, you have complicated FEMA. And that's when a suggestion was given by one of the committee that you formulate master circulars where you consolidate all the circular at one place. So the RBI then started issuing master circular once in a year. But the master circulars were not, they were basically not a statute under the Act. And therefore, to give statutory force, the master circular concept was withdrawn and master directions were introduced. So now, when you look at the law, the Act, the rules, the regulation, and even the master directions are part of statute. So whatever RBI has said in master direction is binding on them. Earlier, the RBI would say that master circular is not binding. The statute, the rules, or the regulations would be binding. But now they made master direction a part of statute. So if there is something in the master direction, it is as good as being the statute itself. Then the RBI website also has FAQs, which are topic-wise. Now, unfortunately, over the past many years, RBI has reduced the number of FAQs that are coming out. And RBI is saying that we are simplifying the law. The new notifications are very clear. The new rules are very clear. So FAQs are not required. So earlier in the old day of FEMA, we had tons of FAQ. We have so many FAQs, like every FAQ had 50 questions, 100 questions. Now you see FAQ, it has only 2 questions, 10 questions, 15 questions. The latest FAQ and ECB has, I think, only 2 questions. So the RBI has reduced the contents of the FAQ. They are trying to make it a progressive interpretation, substance-based law. And therefore, their current thought process is that we are going to reduce the FAQs as much as possible. Now, under FEMA, like in accounting, there are 3 rules for debit, credit. In FEMA, there is also a thumb rule. So every cross-border transaction is either a capital account transaction or a current account transaction. So whenever you undertake a cross-border transaction, it will either be a capital account or current account. There is no third category. And what is the thumb rule? Capital account transaction can be undertaken only as permitted. And current account transaction can be undertaken freely unless prohibited. So it's very clear. Whenever you come across a capital account transaction, you have to hunt where it is permitted. If you come across a current account transaction, unless there is a restriction, you can proceed with it. So this is a thumb rule that every student of FEMA, every practitioner of FEMA needs to keep in mind, right? And FEMA requires you to file a lot of forms. These forms have got simplified over a period of time, and now most of the filings are online. Most of the filings are online. Earlier, it used to be all manual filing. There used to be confusion, whether you filed with the bank, whether the bank has filed with RBI. Now, everything is mostly online filing, so it's getting more simpler day by the day. Now, FEMA being a very small statute, there are several other statutes which impact changes in FEMA. Which are these statutes? The FDI policy. So friends, we have the non-debt investment rules, or the foreign investment rules as we call it. And there are sectoral caps. So insurance is capped at a particular sector. There are conditions for real estate sector. There are conditions for pharma sector. There is a land bordering press note 3 which requires government approval. All these are not requirements of FEMA. These are requirements of the government. They are incorporated in the FEMA because government wants it to be implemented. Certain ministry wants it to be implemented. So they are then incorporated and controlled under FEMA. But here we have to note that a press release or a press note issued by the ministry is not a statute. There are judicial precedents on that to say that they are not statute. Unless a particular press release is enacted under FEMA, it will not be having any statutory force. And the change is effective from the date of notification. The notification can be retrospective as well. So FDI policy influence FEMA. Whenever the government wants changes in the FDI policy, a press release is issued, a press note is issued, and then it is incorporated in FEMA. Then there is foreign trade policy. The import-export is governed by the foreign trade policy. What the country wants to import, what the country wants to export, what has to be permitted, what has to be restricted. This is not governed by FEMA. FEMA only governs payment or receipt. But that piece comes from the foreign trade policy. So some part of the foreign trade policy are also influencing the FEMA. Then I talked about the sectoral regulation. Similarly, NBFC, insurance, all these regulators have their specific requirement. Some of these requirements are controlled even via the FEMA provision. Similarly, Companies Act has certain type of provision for LO, BO. Those are also incorporated to a certain extent or harmonized under FEMA. Similarly, there is an IFSC Act. So whatever IFSC Act gives as a permission under its law, corresponding changes have to be made under FEMA. So a lot of external law influence FEMA. Now FEMA being a very small act regulated primarily by RBI, it's not possible for them to implement it across India. So what they have done is they have regulated several of their powers and responsibilities to the authorized dealer bank. Therefore, whenever you undertake a cross-border transaction under FEMA, the concurrence of the AD bank is very critical. If you go to the banker and say, I want to remit the money, he says no, then you have to challenge him. You can't do anything. Because he is the gatekeeper. He is RBI's gatekeeper to the foreign exchange law. If he interprets a particular provision in a particular manner, you then have to go to the RBI and get that decision overridden. Otherwise, it's not going to work. Okay, it is still possible in today's world that one banker may take one position and another banker may take another position. But by and large, the AD bank's view is very, very critical. That was not the case maybe under FERA because everything required approval. In FERA, whatever you wanted to do needed an approval. You wanted to go out, it needed an approval. You wanted to import something, it needed approval. You wanted to export something, it needed approval. You want to receive money, it needed approval. You want to invest in shares, it needed approval. Everything needed approval. But now, some things don't need approval. It can be undertaken under the general permission automatic route. Therefore, whenever you decide to undertake it, the concurrence of the AD bank is very, very critical. Unfortunately, under FEMA, which is one of the very few law, representation by chartered accountant and lawyers is not very welcome. So there have been some press release by RBI encouraging, constituents to appear before RBI or interact with RBI directly and not through their chartered accountant's lawyer. And this is one of the points which I've been asking ICAI to represent to RBI, that look, we are also trying to help our clients comply with the law. So if on any matter, any chartered accountant wants to represent or meet the RBI, there should be a window available. In the good olden days, there used to be a single window. There used to be a special officer who would just listen to your query and guide you in terms of what has to be done. Currently, that process doesn't exist. So maybe the institute, dignitaries here can take a note And if there is a window to represent to RBI to allow representation, I think representation cannot be taken away. It's a fundamental right to represent through a chartered accountant, lawyer before any authority, and to my mind, diluting it is not in the good interest of everybody. But with due respect, RBI has been very transparent. We've seen they coming and speaking on ICAI forum, various other professional bodies forum. They've been very receptive to ideas, changes, but when it comes to one-to-one representation, today we don't still find that warmth that used to be there, maybe let's say a decade or 15 years back, Now friends, FEMA is so complex, I can tell you, because over 400 notification, over 25 years, there are almost 2,000 circulars, and almost 19 master directions. So therefore, whenever you come across a particular subject, my request to everybody in this audience is, please do not rely on your memory. Please do not rely on your memory. Please go through the act. Please go through the regulations. Please go through the rules. Please go through the circular and decide every time. Because every time that you look at it, you may come across a different interpretation. You may come across a different view. It is simply not possible to remember this complex substance-based law is what I would like to say here. With that, let's look at the structure of FEMA. So as I said, only about 49 section. The first chapter is primarily application and commencement and definition. Then it talks about, section 3 to 9 talks about regulation and management of foreign exchange. 10 to 12 talks about authorized person and delegation of power by RBI. 13 to 15 is the contravention and penalties. 16 to 35 is adjudication of appeals. So if you look at the operative provision, there are only 1 to 12. It's only 12 sections and maybe 13 to 15, which is penalty. So the operative part of FEMA is very, very small, only about 12 sections. The rest is all procedural, appeal, enforcement directorate, miscellaneous. So such a small law. And as I said, therefore, it being only 12 sections, the entire statute is largely governed by rules, regulations, circulars, master directions that are issued from time to time by the RBI. Now let's look at section 1 of FEMA. It extends to whole of India. It also applies to branches, offices, and agencies outside India owned and controlled by person resident in India. So therefore, if an Indian company was to set up a US branch, FEMA will apply to it. If an Indian company was to set up a liaison office in Japan, FEMA will apply to it. Because that office is a person to whom the act applies. And we'll also see the definition of resident. It is also a resident in India. And it applies to contravention committed outside India by any person to whom the act applies. So let's say if one of us was to travel to USA and use a credit card to do something which is not permitted, the act applies. The act is not restricted to action taken in India. So any time that any of you go out, your clients go out, you have to always ensure that the law of FEMA is complied with. Now, obviously, the act applies to certain category of person, and it's an inclusive definition. So the act applies to individual, HUF, company, firm, association of person or body of individual, every artificial juridical person not falling within any of the preceding clause, an agency, office, or branch owned and controlled by such a person. So in the earlier FERA regime, some of these provisions like AOP, artificial juridical person, were not present. And the law was enacted in 1999. Some additional categories were added. And according to me, LLP will also get covered in every artificial juridical person or a firm, because the LLP law came subsequently to the FEMA Act. So it's a very wide applicability. It almost applied to every person that could be a constituent under the FEMA. Then, there are two definitions which are mainly academic, but we'll quickly 1 minute go through it. Foreign security. So foreign security means any security in the form of share, stock, bonds, or debenture, or any other instrument denominated or expressed in foreign currency. So, friends, whenever you are looking at any security, let's say a foreign company has issued shares, bonds, convertible instrument, those will become foreign security because they are denominated or expressed in foreign currency. Similarly, what does security mean? It means share, stock, bond, debenture, savings certificate, deposit. So again, the word security and foreign security is very widely defined. So there could be certain categories of rules and regulation when you apply. You have to go back and apply it with the definition of security as well. And it includes certificates of title to securities, but does not include bills of exchange or promissory note. So obviously we know checks, are not in the nature of security, so they've excluded those categories of instrument, Then there is also a definition of foreign currency. So foreign currency means any currency other than Indian currency. And there is also a definition of foreign exchange. So these three definitions are very relevant: foreign security, foreign currency, and foreign exchange. Now, foreign exchange is a term wider than foreign currency. And it means other than Indian currency, which is foreign currency, and it includes deposit, credit, and balances payable in foreign currency. So let's say if you have an overseas bank account in dollars, it is foreign exchange. If you take traveler's check, if you have bills of exchange, all these are in the nature of foreign exchange if they are drawn in foreign currency. So this is again a concept that you have to keep in mind, that foreign currency and foreign exchange are different concepts, and foreign exchange is a wider concept. It includes foreign currency as well. Now, these two definitions are also very relevant: exports and import. So export means taking out of India to a place outside India any goods. So whenever goods physically move from India to somewhere outside India, it connotes export of goods. And in terms of services, the provision of services from India to any person outside India. So if you are rendering any services from India to any non-resident, it will be export of services. In services, it is not necessary to go outside India and then render services for it to constitute export. So this definition is very relevant because sometimes this definition is not in congruence with some other law. Similarly, when you look at import, import means bringing into India any goods or services. So if you are availing services from a non-resident, it will become import. If you are importing goods physically which cross into India, it will become imports. And then there is another concept which is very relevant in 2Y, repatriate to India. So repatriate to India means bringing into India, means realizing the foreign exchange. So if you are eligible, if foreign exchange is accrued to you outside India, either because of export of goods, services, any other entitlement, you are supposed to bring back the money into India and sell that foreign exchange to the authorized person against rupee. So this is why you can't hold foreign exchange outside India. So let's say if you export goods, unless otherwise it is permitted, you have to bring back the export proceeds and give it to the Indian bank over here against the rupees. Now let's go to the definition of person resident in India. So I know there is a session on residency. There is a next speaker, Naman, who's going to speak on it. So I'm not going to spend too much time, but I'll just touch upon some of the elements of the residential status relevant for individuals and other individuals. So what does the definition 251 says for individual? A person residing in India for more than 182 days during the course of the preceding financial year. So the first test is there has to be an individual. He should be residing in India, and the residency should be more than 182 days in the preceding financial year. Not in the financial year in which you are testing the residence, but in the preceding financial year, and it does not include. So to this test, there are two exclusions, and that exclusion will not make you a person resident in India. What are these exclusions? Person going out of India or staying outside India. So whenever a person is going out of India or staying outside India for these three reasons, for or taking up employment, for carrying on business or vocation, for any other purpose in such circumstances as would indicate his intention to stay outside India for an uncertain period. So if somebody leaves India for employment, from the day he leaves, he becomes a non-resident. A person goes abroad to start a business. He has acquired a residency visa of UAE. He goes to start a business over there. He becomes a non-resident. Somebody goes without, intention to stay outside India is uncertain. Let's say a mother goes to a daughter. She has retired. Now she wants to stay with her son, her daughter. She's not certain when she's going to come back. She'll become a person resident outside India because we don't know when she's going to come back or whether she'll come back or no in the first place. And assuming her visa and other documents support that travel. Because if you're going on a tourist visa, you can never have been said to left for employment or for business or for an uncertain period. So these criteria are very relevant because you may be a resident. Let's say somebody leaves in the middle of the year. Let's say I have this case study here. Mr. Sully, maybe let me cover the second element here. So we saw the 182 days in the preceding financial year. We saw the exclusion for people going out. Now, what are the other exclusion? Coming to India or staying in India, in either case, otherwise then. So it also excludes persons coming to India, staying in India, in either case, otherwise then. That means what it seems to suggest, that the 182 days test has to be applied only for people coming into India, for taking up employment, for carrying on business, or for staying in India for an uncertain period. So it will not apply to a tourist. So if a tourist comes and stays more than 182 days in the preceding financial year, the test will not apply to him. A cricketer comes here to stay and play, 182 days is not relevant to him, because he has not come to India for the purpose of employment, business, or for a period where he is uncertain period of stay in India. That's not the intention. So this test is very, very relevant, and there is a little bit of controversy on whether this second exclusion, otherwise then, so when somebody comes in India for the employment, does he become resident from the date of employment, or you still have to apply 182-day test? Because otherwise the residency may shift to the next year. This is again a controversial issue. I will let Naman deal with it. But I just thought I will highlight that when you test residency, the purpose is also very relevant, and also the term residing is very relevant. And we'll come to that. So now let's look at the case study. Mrs. Sunny Elan comes to India for the first time in June 2019 with her husband and sets up her modeling business activity. Whether she is a resident in the financial year 2019-20. So she has come with her husband, she has set up a business. It looks very unlikely that she is going to go outside India. So she is coming to India and staying in India for the purpose of employment business. So she will definitely be a resident in India. But now the question is, she has come only on 1st June 2019. So if you apply the 182 days in the preceding financial year, which is 18-19, she will be a non-resident. 19-20, she'll stay 182 days. And in the next financial year, 2021, she will become resident. But the better view is that you still take her as a resident in the year 19-20. Because let's say if she is a non-resident, she can't open a bank account, she can't get a credit card. If a Kirana guy gives her credit, it will be contravention of the law. So practically it is better to treat her as a resident, and that's what I assume most of the professionals are doing, including us, where we are treating her as a resident from the day of arrival, even though the law says that you apply the test in the preceding financial year, because by treating her as a resident, I am taking a more onerous obligation on me. Okay, now whether the answer would have changed if she had stayed in India for more than 182 days in 18-19, yes, the answer would have changed, because then she would have been resident. There was no controversy in 19-20, Now, why I went through this definition in so much detail? Because there are a lot of differences in the test of residency under FEMA and income tax. So the section uses the word residing in India, whereas income tax says presence in India. Now, are they the same thing? When do you say a person is residing in India? When he has a house, when he has a family, when he has some attachment. So unlike income tax, which is expressly physical presence based, FEMA is not physical presence based. But for all practical purposes, people interpret residency as physical presence. And as I said, the FEMA test is 182 days in the preceding financial year, not in the financial year in which you are testing the residency. In FEMA, dual residential status is possible. So in 1 year, for a part of the year, a person can be resident, and part of the year he can be non-resident. Similarly, a person can be a non-resident in part of the year, and he can become resident in another part of the year. So unlike income tax, where the residency is same for the whole financial year, in FEMA, there could be split residency. In fact, I've seen people who are resident, who became non-resident, came back, again became resident. So in one financial year, they had 3 status. So even that is possible, Now, in general, citizenship status is not relevant, and the date of arrival and departure India should be included in the 182 days test. That's a better view. And for students who are going abroad, strictly speaking, students who go abroad cannot be treated as leaving India for employment, business, or uncertain period. But the RBI has issued a beneficial circular in 2003 to say that depending on the circumstances, students going outside for studies can also opt to treat themselves as a person resident outside India. So this allows them to open overseas bank account, take overseas credit card, earn income outside and retain it outside. So a lot more flexibility is available when a student becomes non-resident, Any questions still here on individual? Yes? Yes, that's correct. Every transaction you have to check whether your status is resident or non-resident. That's correct. Yep. No, because he still has a predominant business outside India, so that is a very temporary travel. So to my view, when a person is dually employed or he is just a director, he is just coming to fulfill his limited duty. He is not coming here permanently. So to my extent, he will not become a resident. But that's a very case specific. We can pick it up offline as well. But to my mind, we had so many situations where people come here as a director, as a partner, but they are not running the Indian partnership. The Indian partnership may be run by the operating partners, designated partners. So those are the partners who will be exposed to residency, not a traveling partner. Yes. Sorry, I can't hear you. Sorry, can you be louder, please?
Outside, he opens an organization outside India wherein he is a director or say a controlling shareholder in the particular organization, and based on that he represents himself as his intention to move out of India was permanent, and he shifts out of India, becoming a non-resident on the ground that I am moving out of India for employment basis, wherein in that particular year he has some transactions present in India which were truly taxable had he been a resident Indian. So is this sort of planning been challenged by RBI in the past?
Yes, this has been challenged. It is there in the press also, you can see it. And I will let Naman deal with it in the next, which is a 100% topic on the residential
Fair
status.
enough,
but this planning is being challenged. It will not be accepted at face value.
Oh.
That much I can tell you.
Yeah, done.
Yeah. So one thing I also forgot to mention that in income tax you can be resident, but you can be a non-resident under FEMA for part of the year. So there is no need for both the residents to be same. But if they are same, it is better. So typically, the authorities would be very suspicious if you are a resident under income tax and non-resident under FEMA. So let's say he was talking about this planning, because that goes against the substance-based interpretation or the provisions of the law that are supposed to be interpreted. So typically we advise people that, look, it is advisable to be a non-resident under FEMA and a non-resident under the Income Tax Act, but it may not be possible. Let's say somebody has left India for employment in November. So he will always be a resident because he has spent more than 182 days that way. So that benefit may not be available. So in some situations it may be okay, but some situation it may not be okay, All right, so now let's look at the residency test for other than individuals. So a person, body corporate, registered or incorporated in India is always a resident. Sir. Yeah, sorry.
Regarding the 182 days point that you mentioned about the preceding financial year.
Sorry.
So since the Act is very clear on the preceding financial year, why should we take stand on the current financial year too?
Yes, sir, the Act is very clear, but still, as I'm trying to tell you, if somebody is a non-resident who comes here for employment in the first year, he has to open a non-resident bank account. He can't get an Indian credit card. He goes to a hotel, and let's say he goes to a store, a Kirana store, and that guy gives him the credit. It will be treated as a credit to the non-resident. So it will fall of Section 3, which will come to in a while. So therefore, the better view is that you treat him as a resident, and you treat him as a resident, you are taking more onerous obligation of FEMA. FEMA applies less to non-resident, more to resident. And if you don't do what is prohibited for non-resident in your residential status, that's considered to be the optimum situation, So you take a more onerous responsibility. The regulator cannot say why you chose yourself to be resident. Okay, I chose to be governed by FEMA in a very much bigger way, because the residence is far greater controlled under FEMA as compared to non-resident. Right? Okay. So let's quickly look at the other test of residency. Any person, body corporate, registered or incorporated in India. So the moment you are incorporated in India, an Indian company will always be resident. Any office, branch or agency in India owned or controlled by a person resident outside India. So let's say, Google, US, sets up a branch in India. That branch will be an Indian resident. It will be subject to FEMA rules. An office, branch or agency outside India owned or controlled by person resident in India. Tata's were to set up let's say an office in the US or let's say an office in Japan. It will be a person resident in India. So now what does this definition say? That the foreign companies can never be person resident in India. I'm using PRII as person resident in India and PROI as person resident outside India. So a foreign company by default can never be a resident in India. Similarly, an Indian company can never be a person resident outside India. So unlike in income tax, by shifting the control and management, you can become non-resident. In FEMA, that kind of planning or opportunity is not available. A branch, office or agency in India of a foreign company is always a resident. And all body corporates incorporated in India will also be always a resident. All person registered in India will always be a resident. Overseas branch, office or agency of a resident is always a resident. Now let's say you have to have an agent in Japan. Your client wants to have an agent in Japan. That agent's actions are actions of an Indian resident because he is acting on behalf of an Indian resident. The NRIs, PIO and OCI are not defined under the Act, but they are defined in different rules and regulations. So we'll go to that slide. So again, this is an example. I don't know whether we want to go into it in interest of time, but I think we've debated some of these issues, so maybe I can skip this. Now, the OCI card is very relevant. Again, I'm not going to go into the definitions of OCI, but why is this card very relevant? See, earlier under FEMA, there was a concept of NRIs, means Indian residents staying outside India who is a citizen of India. So when you are referring to an NRI, he is an Indian citizen who is staying outside India or employed outside India. Then there was a concept of person of Indian origin. And the person of Indian origin was a concept that was defined under FEMA. But over a period of time, when the OCI provision came in, the overseas citizen of India, the PIO definition was diluted under FEMA. And now the only definition that is relevant is OCI. Now, you don't only have to be an OCI, but you need to have an OCI card. So the current FEMA rules and regulation give you the benefit of certain provisions or treat you on par with NRI only when you have an OCI card. So therefore, whenever you are dealing with a foreign citizen and you want to give that foreign citizen the benefit of provisions relating to NRI, you have to first ensure that he has an OCI card. Because if he does not have an OCI card, you can't give him the beneficial provisions of NRI. Because under the Act and the rules and regulation, NRIs and OCI, in most of the cases are 99% of the cases treated on par. But you can't just satisfy the definition and not have an OCI card. You will need to have an OCI card. So therefore, the thing when this change happened, all practitioners went on and told all their clients, okay, look, earlier you were eligible for benefit of NRI by way of a definition in FEMA. But now you will not be eligible unless you obtain an OCI card. So therefore, let's say when there is a newborn child born to someone, a foreign citizen, the first thing we would say is go and take an OCI card for that child. Because if you want to do anything vis-a-vis that child in India, you will not get the benefit unless you or that person has an OCI card. Let's say somebody marries a foreign citizen. We advise that the first thing that the foreign citizen should do is go and take an OCI card. Because if the person doesn't take an OCI card, that person's own individual investment in India will not be treated on par with NRI. So the OCI card by itself has become very, very relevant in FEMA, which was when the law started in 2000, it was not that very relevant. But over a period of time, it has become very, very relevant. And of course, I'm just to touch upon some elements of OCI, person who was a citizen of India at the time of the commencement of the Constitution, who was eligible to become a citizen of India, who belonged to a territory that became part of India, child, grandchild or great child of an Indian citizen, who was earlier an Indian citizen, is a minor child of such person. So there are various criteria under the OCI card. Again, I am not an expert on OCI card. What all I want to tell this group is, please ensure that if your clients are foreign citizen of Indian origin, they must have an OCI card to transact under FEMA, Or the last category is spouse of a foreign origin of a citizen of India or spouse of origin of an OCI, And the marriage has registered and subsisted for a period of not less than 2 years. So earlier people used to get married to get OCI card and then take divorce. So now the government has said that the marriage must subsist for a period of 2 years for the spouse to become eligible for an OCI card, So as we see, the FEMA law and the OCI law also has evolved over a period of time, Then we come to the definition of capital account transaction. And any questions till now? Any questions? Yeah. Sorry? Yes. 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 That is a foreign company incorporated outside, non-resident. Subsidiary is not an office, definitely. But let's say, see, the problem is the word office need not always be a formal office. Let's say you have one employee sitting there, you have kept your board over there. It will become an office. Even if it is your subsidiary, it will be assumed that you have an office in that subsidiary. So how you choose to operate outside is very relevant, So you have this LOBO, I think a session on that, right, as well, possibly. So you can cover that on that, because that what is an office, when you constitute an office, what is an agency, when you constitute an agency, each of these elements, if I speak, it will take an hour on each of these sub-elements, and I'm conscious of time. Yes?
Shabbir bhai, say if an Indian company, say L&T of the world, has a project outside India.
Yes.
Okay, then that project office will be treated as a resident?
Yes, absolutely.
And so say, there is a, Indian company who is procuring goods from overseas and supplying, say, they have the project in, say, Bangladesh. And this gentleman imports the goods from US and do the MTT transaction. Okay,
yes.
Directly sending goods from US to Bangladesh.
Yes.
Okay, another Indian company.
Yes.
So here, will that transaction be regarded as a transaction between two residents, because L&T is resident and here the Indian supplier is also a resident?
So what is your good name?
Ravi.
Very good question, And actually you preponed actually a couple of my slides, but you please complete your question, please.
Yeah, so here the question is on, whether it is a R2R transaction, and another is here the export. If you see the definition of export, the goods are not leaving India.
Right.
It's MTT.
Right.
So I have two questions essentially, whether the project exports, that thing will apply, or it is a MTT transaction. And
right.
whether it is a R2R transaction, so FEMA at all doesn't apply.
No, so depending on based on the status, it is an R2R transaction, but there is a framework for such project execution outside India. There are PEM guidelines that the RBI has issued, under which either the Exim Bank or the AD Bank can give you permission to undertake this transaction. It's almost a 30-40 page guideline, and it deals with everything, because there you may need to give guarantee, you may need to place deposits, you may have retention money, you may have you may need a foreign bank account to execute that project. You may have to employ overseas consultant. So there are hundreds of things attached to execution of project, procuring, and from outside India, procuring from India. All of that is covered under project export management guidelines. It is known as PEM guidelines, and you refer those guidelines, all your questions will be answered there.
Okay, sir, and if I refer that guidelines PEM, then I don't need to refer MTT at all, right, for this transaction? So
yeah, please understand, PEM you have to take approval from the bank. Even MTT requires approval from the bank. So, but there are additional criteria. So if you are under PEM, MTT will not apply. If you are MTT, then PEM will not apply. One of them will apply, whatever is the right one.
Okay, thank you.
Yeah. Yeah, any other question? Okay, now we come to the most dangerous definition in FEMA, capital account transaction. Why it is dangerous? Because it can be undertaken only as permitted. So therefore, this definition is more relevant than the current account definition. Now, what does it say? Capital account transaction means a transaction which alters the assets or liabilities, including contingent liabilities outside India of a person resident in India. So any transaction that you undertake as a resident, which alters your assets or liabilities outside India, that would be a capital account transaction. That means you are acquiring shares of a foreign company, you are giving loan to a foreign company, you are giving guarantee for a foreign company or a non-resident. All these are what are altering your assets and liabilities outside India, and therefore they are capital account transaction. Or which alters the assets or liability in India of person resident outside India. So when a non-resident acquires shares of Indian company, when a non-resident gives loans to an Indian company, these are all capital account transactions, and they include transactions specified in section 6. Now, the fundamental 2 points that I want to highlight over here is that the term alter is not defined. So alter I would assume to mean change. So there was an X position and it changed to a Y position. And the criteria of contingent liability is relevant only for resident and not for non-resident. And the reason is, let's say as a resident, I create a contingent liability for my country. So once I've created for the liability, it could create an outflow after some time. Let's say I've given a guarantee. If the guarantee is invoked, I'll have to remit money. So when a resident creates contingent liability of foreign exchange cross-border, it is treated as a capital account transaction because it could potentially result into outflow from India. But let's say a non-resident was to give a guarantee. There is no outflow from India. If at all there is an outflow in India, so we may not control that part. Then they are controlling the remittance of the amount that has come. So there is a slight definition. So residents are subject to a greater test of under the capital account transaction, and the transactions of contingent liability are also covered, whereas for a non-resident only assets and liability chain is covered. So I thought this is very relevant, and as I have mentioned, the thumb rule is capital account transactions are generally prohibited unless permitted. So therefore, for every capital account transaction, there is a rule or a regulation, and we'll come to that. So these are the typical, so if you want to understand the capital account transactions which are controlled under FEMA, there is a FEMA 1 notification. And this is the list. I don't intend to go through the list, but let's say investment by a person resident in India in foreign security, foreign exchange loan, acquiring immovable property outside India, giving of guarantees, export, import, holding of foreign currency outside India, loans overdraft. So these are all taking out insurance policies. These are all examples of capital account transaction of resident. Similarly, the counter side is investment in India by a non-resident, acquisition of immovable property in India by a non-resident, these deposits, foreign currency accounts in India of a person resident outside India. These are capital account transaction of a non-resident. So there is a list which is available in the FEMA notification. Almost any transaction that you undertake, you have to search for permissibility under this schedule, read with the relevant regulation. So every of these elements, there is one rule or regulation. So investment by a PRI resident in foreign security, we have overseas investment rules and regulation. Investment in India by a person resident outside India, we have the non-debt instrument rules and regulation. So every capital account transaction is supported by a rule or regulation, and what is doable or not doable, you have to go back to that rule and regulation. Similarly, guarantee, there is backed up by a guarantee regulation. Immovable property is also covered under the NDI or OI rules and regulations. So every of this transaction is supported by a rule or regulation. Then let's look at current account transaction definition. So current account transaction means other than a capital account transaction. So first of all, to be a current account, you don't have to be a capital account. And without prejudice to the generality of the foregoing, it includes payments due in connection with foreign trade, other current business services, short-term banking and credit facilities in the ordinary course of business. So when you import something and you have a payable, it is a current account transaction. So even though it alters the assets and liability, but it is in the course of the business and trade. You give some short-term credit to your foreign customer. You give him a 6 months credit for exports. That will not convert it into a capital account transaction. So any payment due in connection with foreign trade, business, that is not a capital account transaction, it is a current account transaction. Payment due as interest on loan or income from foreign investment, that is not a current account transaction. Remittance for living expenses of parents, spouse or children residing abroad, that is not a capital account transaction, it is a current account transaction. Expenses on foreign travel, education, medical care, of self, parents, spouse, children. These are all specified capital account, current account transaction. They are not to be categorized as capital account transaction. So again, I just repeat for the sake of repetition, every transaction under FEMA is either capital or current account. Capital account transaction generally prohibited unless permitted. Current account transaction generally permitted unless prohibited. And please don't go with the taxation or accounting meaning of this treatment. In accounts, we would have an import and we would capitalize it. It is a capital account transaction under accounting, it is a capital transaction under tax, but it is a current account transaction under FEMA. So those accounting and taxation terminologies are not relevant. Let's look at some examples of capital. Import of machinery in cash or short-term credit, it's current account. Import of machinery for extended credit, let's say 6 years, 10 years, it's capital account. Loan for investment in machinery, working capital, current account, capital account transaction. Investment in equity shares, capital account transaction. If you have any doubt on what is capital and current account, please be conservative. Please take it as capital account. Because unless it is in the course of the business trade, you may not get the categorization right. Yes, Mr. Ravi. No, so that's a very interesting question, Mr. Ravi. And see, intangibles are attached to the owner. Under the current Indian law, intangibles are not attached to the location where they belong. So if you have a marketing authorization in US, the location of that marketing authorization is the owner who is in India. So it's an Indian asset. It's not a foreign asset under the law.
Okay, and then this transaction.
So there is no, so when I acquire a marketing intangible outside, or a marketing authorization outside, let's say the Indian company has acquired.
For the India. And for that, they need to make payment to the US entity. So here, there is nothing which is.
But I'm not changing my ownership. No, it's just a sub-license.
It is a sub-license. For India, they are giving an exclusive license to the Indian company.
Another Indian company.
To the third-party Indian company. And they are, Indian entity has to make payment to the overseas company. So here there is no goods which is imported. The US company is not providing any service whatsoever, but it is just giving a sub-license to their intangible property.
Okay. So maybe we'll take it up offline because it's a little specific. So maybe after the session we can pick it up. But let's not take everybody's time there. Yeah. Yeah, what's your good name?
Shashank.
Very good question. Yeah, very good question.
Like if in a general business, the credit extends to like 4 years or 5 years of term, then it will be treated as a current account transaction because it's worldwide accepted that it's...
No, so in the borrowing and lending regulation, in the ECB regulation, trade credit of more than 3 years is anyway treated as a capital account. So there is a specific provision now. You don't need to have your own period. This was more given to you conceptually, but generally a 3-year and above period is treated as capital account. Less than 3 years is current account.
Thank you.
In general, I'm saying not a very strict thumb rule, but that's how the law has evolved over a period of time. And I think in the borrowing and lending regulation, somebody will cover it, as well. Right? Okay. Any other question? Okay, now we come to the most dangerous section, section 3. So it says, section 3A says, save as otherwise provided in the Act, rules or regulation or general or special permission of RBI, no person resident shall deal in or transfer any foreign exchange, foreign security to any person not being an authorized person. That means any transaction that you undertake of foreign exchange, foreign security has to be through an authorized person. So this is mainly prohibiting your hawala transaction. So you can't go and buy foreign exchange from an unauthorized person or a vendor, and that is where this provision is very, very relevant. So every transaction of foreign exchange or foreign security that you undertake has to be routed through an authorized person who is an 80 category bank. You are not allowed to buy foreign exchange from anybody else other than the authorized person as constituted under the FEMA. Then 3B says you are not supposed to make any payment to or for the credit of any person resident outside India. So unless the Act permits, you will not make payment in any way to any person resident outside India. Or receive otherwise than through authorized person. Any payment by or on order behalf of any non-resident. Some non-resident has to pay you something. You can't receive it other than through authorized person. So this is the core of FEMA, where every foreign exchange transaction has to be undertaken through an authorized person who can be a bank, who can be an FFFMC, who can be a money changer, who can be a license holder of RBI. You have to undertake that transaction only with that person. If you do not undertake that transaction will become an illegal, even though the underlying transaction may be permitted. Let's say you have done an import, but you sent payment through your friend. He carried some foreign currency outside when he was traveling. That is not a payment through authorized person. Even though the import is permitted, even though you may have a bill of entry, but the payment has not gone in accordance with Section 3, that would be a contravention. So every transaction has to be routed through the authorized dealer bank. Okay, so I think this is okay. I think we'll skip in the interest of time. Again, there are, Section 456 talks about holding of foreign exchange. You are not allowed to hold foreign exchange beyond the prescribed limit. So it's not that I can buy $10,000, $50,000 and keep it in my cupboard. That's not going to be possible. So you are supposed to hold only certain exchange for certain purposes if it is arising from certain, way of earlier transaction. And again, Section 5 allows you to draw money for current account transaction. I think, again, we can speak. Section 6 talks about drawing of, foreign exchange for capital account transaction. As I told you, RBI in consultation with central government can specify and regulate debt instruments. Central government can, in consultation with RBI, regulate non-debt instruments. So RBI is allowed to regulate now debt instrument, and central government is allowed to regulate non-debt instrument. Non-debt instrument are primarily equity or compulsory convertible instrument, So again, there are some general permission to hold foreign exchange, Indian assets and stuff like that. We can skip that. Now this 6465 is where I wanted to spend a little bit of time. So what happens if you are a non-resident and you become a resident? Then what happens? Are you allowed to hold your foreign exchange asset, foreign assets, immovable property? The answer is in 6.4. So it says a person resident in India may hold, own or transfer or invest in foreign currency, security or immovable property situated outside India if such asset was acquired by such person when he was a resident outside India or inherited from a person resident outside India. So this is a transitional provision. When a non-resident becomes a resident or resident inherits exchange currency or property outside India from a non-resident, that property can be held outside India. It is not required to be converted and brought to India. And 6.5 is the reverse. When you are a resident and you become a non-resident, your Indian assets are grandfathered. You don't have to dispose of those Indian assets. So 6.4 and 6.5 are very, very important provision, and they are very relevant for change in status and inheritance purposes. So any case like that you come across, please apply Section 6.4, 6.5. Some of the other inheritances from NR to NR, other R to R, they are all covered under the specific rules and regulation. They are not covered under the Act. But the Act very categorically covers, continuity of assets for change in status and inheritance. So when you acquire something under inheritance, it cannot be stopped under FEMA. Similarly, under inheritance, you can pass anything to anybody because the inheritance law has been given the right to override FEMA. So inheritance is the most safest way of otherwise transmitting an asset, both inside India or outside India, And then the 6.6 talks about the branch office or other place of business of non-resident for any activity relating to branch or trade. So I think Section 7 talks about declaration of export. So whenever there is an export of goods, you have to give a declaration. Earlier there was this different forms. Now you have the EDF form that has to be declared. That form goes under the EDPMS database of RBI. Whenever you realize money, you have to offset against that. So that particular piece is controlled because India wants to control every export and foreign exchange receivable and track the receivable to that exports, So this is the core of export. There are timelines for realization. General timeline is about 15 months, from the date of exports. And then in any other case, you could be 7 days or 90 days. So, currently we don't have reporting for services, but under the new import-export regulations which are enacted and which come into effect from 1st of October 2026, there would be a reporting even for services. So let's say a chartered accountants may also require to report export of services. It will go in EDPMS. It will also have to be tracked. So I think in the import-export, guidelines, those can be talked about, Now again, this is exemption from Section 4 and 8. Again, not that very relevant. 10, 11, 12 are, authorized persons. So RBI is authorized to appoint authorized dealers, money changers, offshore banking unit, and it can inspect their transaction, it can impose a penalty, it can impose other controls on those authorized person. So those powers of RBI come from section 12. Now let's look at the penalty section. Now there is only one substantive section under FEMA. So if any person contravenes any FEMA provision, rules, regulations, he shall be liable for penalty up to 3 times the amount involved in such contravention where the amount is quantifiable, up to 2 lakh rupees when the amount is not quantifiable. But since FEMA transactions are in monetary terms, most of the times your amounts are quantifiable. I've seen very few cases where the amounts may not be quantifiable. And if the contravention is a continuing one, there is some per day 5,000 rupees default. So unlike income tax where there is misreporting and underreporting, 50% and 200%, here it is up to. So your penalty can be 1% of the contravention, 5% of the contravention, 50%, 100%, 200%, 300%. It is for the adjudicating authority to decide. And the adjudicating authorities are not RBI officers. Penalty is technically levied by the enforcement directorate. And then there are other provisions for recovery of penalty. And if you don't pay the penalty, there could be prosecution as well. And there is also power to confiscate assets to recover the penalty. Now let's look at some other provision. And here I would like to touch upon, section 14 is the order of adjudicating authority. So how penalty is initiated? Just a very quick perspective. See, as I said, there are no power of search and survey under FEMA. So the enforcement directorate is authorized to levy penalty. So they typically call for information under 133(6) of FEMA. Now, of course, under the 2025 Act, the corresponding section. And then there is a complaint that is filed with the adjudicating authority that this provision has been contravened. After the complaint has been filed, there is a show cause notice that is issued. You are allowed to represent before the show cause notice, and then a penalty order is passed, which is an appealable order. Now, instead of being subject to penalty, or as soon as you notice a contravention, even before the authorities come to you, you can voluntarily choose to go under the compounding provision. So, under the compounding, the idea is to reduce the burdens and the compliance costs. It's a voluntary application in prescribed format to RBI. There is an application fee of 10,000. And before you go under compounding, you are supposed to complete all the administrative procedure. Let's say if you need a prior approval of the RBI or the government, that approval has to be obtained, and then only a compounding can be filed. Compounding is not available for serious contravention. Let's say you've done a hawala transaction, you intentionally broke the law. Those kind of things will not be covered under compounding. And there is a 3-year limitation period. So if you've contravened a particular law and a compounding order has been passed, if you do the same contravention within 3 years of that order, then compounding is not available. So again, I believe in the compounding part, you will go into much more detail, but I thought I'll just give you a quick perspective of compounding. And then most important, section 42, contravention by companies. So it is not only the company who can be penalized. So every person in charge, responsible for the conduct of business, is also deemed to be guilty of the contravention. And there are some person who consent, connive, neglect, any director, manager or officer can also be subject to penalty. So here I wanted to emphasize is many people believe that if a company has contravened the provision, only the company can be subject to penalty. But we've seen the ED issue notice to directors also. And even directors separate penalty has been levied. And a company here includes a body corporate, a partnership firm, and an LLP also should be covered. And if person dies, the proceeding continues on the legal representative. Now, very quickly, we'll go through the important rules and regulations under FEMA. So as we said, every capital account transaction, there is a specific rule. So for foreign investment, you see, there is non-debt instrument rule, notification 3732. There is mode of payment and reporting of NDI regulation and debt instrument regulation. So foreign investment framework is governed by 2 regulations and 1 rule. The rule is notified by the government and the regulations are notified by the RBI, and there is a master direction number 11. So in these 2 slides, I have covered the top 15 master direction and about some 20 odd top rules and regulations. There are many others which are not generally applicable, so those have not been covered. So the most important being the foreign investment in India. So 1 rules and 2 regulation, overseas investment from India, one rule and one regulation, overseas investment rule and overseas investment regulation. And the corresponding master direction is 15. So when you are talking about foreign investment, please refer to these rules and regulation and please refer to this master direction. Similarly, borrowing and lending, either in India or outside India. There is FEMA 3R, borrowing and lending regulation, and there are two master direction 5 and 6. And there is a guarantee regulation that also becomes relevant, which is covered both by master direction 5 and 6. The liberalized remittance scheme for resident individual, which is the most popular one, it is governed by RBI master direction number 7. Similarly, there is a deposit regulation, all your FCNR account, NRO account, NRE account, all these are governed by the deposit regulation, or foreign currency account by person resident in India, your EEFC account, all of these are governed by these two regulations, and the master direction covering them is number 14, Acquisition or transfer of immovable property under FEMA, NDI rules and OI rules covered, and the master direction is master direction number 12. If you want to remit assets from India, let's say you have inherited something, you want to remit, there is a widow who's inherited something from a husband, wants to remit something, all of this is covered under the remittance of asset, master direction number 13. Foreign company wants to establish in India a branch office, project office, any other place of business, there is this FEMA 22, master direction number 10. Export of goods and services, FEMA 23R, master direction number 16. Import of goods and services, current account transaction, master direction number 17. And current account transaction, there are two other smaller master direction, other remittance facility and miscellaneous. Reporting under FEMA, there is one master direction, number 18. And compounding, again, there is a separate master direction, number 4. So every rule and regulation, topic-wise, is available on the RBI website, and each rules and regulation has one master direction. So you don't have to go and hunt every individual circular, every individual notification. Consolidated notification, consolidated master directions are available on the RBI website. And as I mentioned, there are new import-export rules that are set to come in from 1st October 2026. They've been notified in Jan 2026. These are a bit complex, and we will leave it to the next speaker to deal with it, and maybe these master directions may also get replaced then, Now we come to the late submission fees. So friends, when FEMA was operationalized and if there was any delay in filing forms, it used to attract compounding. And when compounding was operationalized in 2005, 2006, almost out of 1,000, 800 cases of compounding related to delay in filing forms. And those required giving so much data to RBI requiring to give you a hearing, and then the order to be placed on the RBI website. So it created too much turmoil, and I think over a period of time, we have this late submission fee which came in FEMA, and now it is applicable to foreign investment, ECB, and overseas investment transaction. And it first came in foreign investment transaction from November 2017. For ECB, it came from 2019, and in OI rules and regulation, it came from October 2022. So essentially, if there is any delay in filing, you can just pay the LSF, which is either 7,500 or 7,500 plus 0.025%, depending on the category of the form, and you can be with it. So LSF is generally computed by the AD bank post the belated submission. Some of the LSF computation also happen on the RBI portal. And the maximum amount is 100% of the amount involved. So the LSF fees cannot exceed. So let's say if your contravention is 1,000 rupees. So the LSF will be 1,000, not 7,500. LSF needs to be paid within 30 days from the date of provisional acknowledgement issued by the RBI. And the facility for LSF is generally available up to 3 years. So if you're doing the LSF within 3 years of the late filing, if your filing is late by up to 3 years, then you can take LSF. If it is beyond 3 years, you may have to undertake compounding, You may choose between LSF and compounding, but generally LSF always results into a lower percentage. The compounding fees under the compounding metrics are generally always higher, So now, friends, this is the import and export. So as I said, there are various facets to the import and export. So as I said, import and exports are first influenced by the foreign trade policy. The foreign trade policy issued by the government decides what has to be permitted and what is not permitted for import and export. Similarly, various other type of import, like let's say, import on lease or very special category of import, all that is coming from the foreign trade policy. The permissibility of the import and export is not governed by the RBI. It is governed by the government and the foreign trade policy. Many times people ask me, can I export this under FEMA? Export is not gone by FEMA. Export is gone by the foreign trade policy. After you exported, the realization of money, that obligation comes from FEMA. How to realize the money, that obligation comes from FEMA. But what to export is not coming from FEMA. Similarly, what to import, that is not coming from FEMA. But after importing, how you should pay for the import, that is coming under FEMA. So therefore, when you are dealing with import, you have to first look at the definition of imports. You have to look at the foreign trade policy. For payments for import, you have to look at the FEMA provision. And as I mentioned, that every import of goods goes into an RBI portal called IDPMS, Import Data Process Monitoring System. And whenever you make the payment has to go in IDPMS, and both of them get knocked off. What I understand currently is that IDPMS is also now interacting with the IceGate portal of the custom. So the custom database and the RBI database are now talking to each other. And if you have actually paid the money, but it is still outstanding in IDPMS, as per RBI record, it is outstanding, even though you have paid. You have to get it rectified in IDPMS, and I've seen cases where if it is not rectified, the ED has issued notices and you could be subject to penalty. So, and it is a very onerous to appear before the ED in such things. So the best thing is, I think every audit, every client, you should periodically check IDPMS, EDPMS and ensure that correction entries are done. If there is a delay in payment of imports, there are specific guidance, what delays are acceptable, what delay is not acceptable. Instead of making payment to the supplier, you want to make payment to a third party, that is also possible. You want to pay interest, you agreed to pay the money in 6 months, now it is 7th month, you want to pay interest for 1 month, even that is provided for. There is a specific mention about evidence for import. So when you go and make the payment, depending on the size of the import, the evidence of import that is required to be given to the bank changes, There is also a set-off of import payable against export receivable now, which is permitted. So the import-export master direction and the guidelines are pretty detailed. And therefore, I think this is one of the most fundamental elements of our advisory in FEMA. Similarly, when you go to meaning of exports, please go through the definition. And there are specific terms like services and export of software. Software is defined. Service is defined under FEMA. You cannot apply the definition of software from GST or services from GST. You have to look at the specific definition of FEMA and then categorizes as an export of software or export of services. Because an export of software is required to be reported to the RBI, Then there is an export declaration form where you have to declare the true and fair value. So whenever you are exporting something, the value that you declare in the form is constituted to be the true and the correct market value. So you can't export, let's say, a Mercedes at 500 rupees. That's not going to be acceptable. So whatever value that you declare in the export form, please ensure that is the right value. And otherwise, you could be investigated as to why did you export something at such a low price, Similarly, in the export rules and the master direction, there are guidelines on how you should realize the money with respect to goods, software, services. Can you realize from your customer? Can you realize from third party? What kind of documentation should exist? As I said, exports go into EDPMS, export of goods and computer software. When you realize your export proceeds, can you deposit it in your EFC account? Are you allowed to open a foreign currency bank account? Again, that is permitted. Can you get advance against export? Again, there are conditions and guidelines for that. After exporting, the quality of the good was not that good. The customer doesn't want to pay you 100%. Can you pay 80%? Can you pay 80%? Can you pay 90%? Even that is clarified under the master direction and the rules. The supplier agreed to pay you within 6 months. He's not able to pay you within 6 months. Now he wants to pay you within 9 months. Will that be permitted? Extension of period, all that is specified in the rules and regulation. Somebody has not paid you. You have exported to 100 customers. One customer does not want to pay you. Can you write off that export receivable? There are again very specific terms and conditions for authorizing that write-off. So you go to an authorized dealer bank. So there are 3 categories of write-off. Self write-off, there is up to, I think 5% you yourself can write it off. Then another 10% is with, I think, AD Bank's approval, and another 15% with RBI approval. So there are some specified percentages within which you can write off. So self write-off 5%, 10% with AD Bank, and over 15% it has to go to RBI. So again, every time you come across a transaction of import-export where there are these complexities, please look at the guidelines. Yeah, that's correct. That's correct. That's correct. Yes, yes, it will apply. Yes. Yes. No, you will receive in foreign exchange. So the unit, see, there are the IFSC entity is always an Indian company. The unit of the Indian company in IFSC is a non-resident under the IFSC rules and regulation. And therefore, when you export to that unit, it is as good as export to any other non-resident. And the same rules apply. Yes, yes, you will be able to receive in foreign currency. And the same rule applied for SEZ also in that time. So that's why I've said there are special provisions for SEZ as well. So those units are allowed to transact in foreign exchange. So you are allowed to receive in foreign exchange as well. Sorry? Yeah, so because typically IFSC is a financial service entity, so you may export goods for setting up their offices or whatever, but otherwise it's primarily a transaction of service. So you will be eligible to receive in foreign exchange. Immediately, let's say you invest in an IFSC entity, that is treated as overseas investment as well. So all the forms and all the conditionalities apply, Now, there is one more very interesting thing for exports. When you export, not only you are allowed to export directly to the customer, you can set up a liaison office outside India, you can set up a branch office outside India, you can set up a warehouse outside India, you can set up an agent outside India, you can even do an export on consignment basis. So all of these type of exports, there are very specific guidelines given in the regulation. So you don't have to scratch your head for all these transactions over these last 2.5 decades have almost settled down, and they are very easy to implement. Even some merchanting trade, as Mr. Ravi was mentioning, they are very specific guidelines. Okay, they're a little onerous, but there are specific guidelines, and if you fulfill those guidelines, you can undertake some of these transactions very, very easily. And lastly, the project exports, the PEM guideline, which Mr. Ravi was mentioning, that let's say an L&T is executing a highway project, let's say in Dubai, or let's say in Mauritius, or let's say in a third world African country, let's say Uganda, Tanzania. And it has to send material, it has to send people, it has to procure material from outside. So all of these, amalgama approvals that are required, they are granted by a bank. There is a form that is required to be filed with the AD bank, and then the AD bank gives you the approval based on the tender and the project condition, and then you can operate within the. So all of these, what you mentioned, are very easily doable. We've seen tons of that in real life, So current account transactions, there are current account transaction rules, and if the transaction is permissible, you can buy foreign exchange from the AD bank. And essentially, there are 3 schedules. I don't want to get into those schedules, but there are 3 schedules in current account rules. There is Schedule 1, where some kind of transactions are expressly prohibited, like gambling, betting, transactions which require prior approval of the government. So there is a Schedule 2, where certain transaction which you undertake, you will be allowed to make payment only if you have the approval of the government. And there is a Schedule 3, where there are certain type of transaction which you undertake, like donation, which exceed a certain threshold. Then you will need a prior approval of the RBI. So first, there are 3 schedules. Current account generally permitted. There are 3 schedules. Schedule 1, completely prohibited transaction. Schedule 2, transaction which require government approval. Schedule 3, transaction which require RBI approval. And in the Schedule 3, certain categories of transaction, if you pay from your EFC account, you don't need an RBI approval. And as I said, there are the master direction also which elaborate on these current account rules. So I think please go through them. With that, I just thought I will give you, snapshot of some RBI website. So the most important website currently is the Firms portal. The Firms portal is the RBI's foreign investment reporting and management system portal, which allows reporting of transaction pertaining to foreign investment, including fresh investment and transfer of equity or equity instrument. So all these forms that you have to file, FCGP or FCTRS, LLP 1, 2, ESOP, downstream investment, all these forms are required to be now reported through the Firms portal. Earlier, all these were manual filing. Now through the Firms portal, you file, it goes to the bank approves, it goes to the RBI, and the RBI gives you a registration number. So These portal has been enabled to make the process of filing more friendly, to allow you to track what is accessing. The unlike Forms portal, the ODI portal is currently not available to the resident making the ODI. That access is available currently only to the authorized dealer bank. So whenever you have done an ODI, there is a report that gets generated on the RBI website called project profile. So you must ask the AD bank to give you the project profile from the RBI website, because then you can tally your records of ODI with the RBI records of ODI. So that piece is again very relevant. I think annually we should ask the AD bank to give you the project profile for ODI. And the Forms portal, as I mentioned, is relevant for FDI and foreign investment. Similarly, if you want to take any government approval for any sector which is falling under the approval route, this is this FIFP portal, the Foreign Investment Facilitation Portal. It is a single window of the government to obtain all approvals of FDI administered by the DPIIT through the Ministry of Commerce. So there is a particular website, you create your registration, you upload your application along with everything, and the approval is again processed through the FIFP portal. The RBI also issued a PRAVA sometime back. I think PRAVA came about 8-9 months back or about a year back. So any application now that needs to go to the RBI has to be filed through the PRAVA portal. You can't go and now lodge a physical application with anybody. You have to file it through the PRAVA portal, interacting with your AD bank, and this includes all kind of application, including compounding, any permission that you need or whatever. So the PRAVA link is also available. So that is something that you should know. And then there is a FLAIR portal, Foreign Exchange Assets and Liability portal. So you have to file an FLA return once in a particular period of a year. That is 15th of July, and this has to be filed on the FLAIR portal. And this applies to any entity which has received FDI or ODI or who has taken ECB. So these entities are required to file this form FLA on the FLAIR portal. So these 4 portals currently are very relevant whenever you are dealing with FEMA. So whenever you have time, please browse these websites. I'll be sharing this presentation with you, so you will get the link and the HTTPS. But some of these have made our life very simpler, because in the past all of these used to be manual filing, used to have acknowledgement, the application was not traceable, and then you used to file a copy again, and all those problems are now currently no longer existing. As I said, most of the filings and processing of application in RBI has got digitalized. Now friends, with that, let us spend a few times on do's and don'ts of FEMA, on when you interpret FEMA. So as we saw that FEMA is a very small act, 49 section, 400 plus notification, 1500 plus circulars, almost 20 master direction. So it is a statute governed by rules and regulation, notification and circular, and not by the act. Unlike income tax where everything is in the act, in FEMA everything is outside the act. So that is one piece you have to bear in mind, and FEMA is a substance-based law. FEMA you can't interpret like income tax act. You can't interpret every full stop, comma and say it means only this and nothing else. So you have to do a purposive interpretation of FEMA, like the other gentleman talked about dual employment, somebody coming for 30-40 days. 30-40 days cannot make you a resident. You have to go with the substance. Employment means proper employment, long-term employment. So you can't play around with words the way you want, Then literal interpretation is not the right approach. It's substance-based law. Every court decision that is on FEMA, though there are very few, is based on not literal interpretation, but substance-based law. And again, one thing, unlike in an income tax appellate tribunal, high court, the view is that the view favorable to the taxpayer has to be taken. In FEMA, it's not like that. It is not like that they'll take a view which is favorable to you. They will take a view which is meeting the purpose of FEMA or the objective of FEMA. So you assume that, no, the language is a little bit loose, so they'll take a view in your favor. It's not going to happen. The authorities have always taken a view which has supported the object and purpose of FEMA. So you can't expect them to take a wide interpretation of the law. And sometimes under FEMA, there are some provisions, clauses, schedules which are inserted by other ministry. So the RBI has to reach out to those ministries to understand what is the meaning of this term. Let's say on a sectoral policy, let's say in a real estate sector, you have certain terms which are to be interpreted. Those terms will never be interpreted by RBI because they were not the ones to incorporate that. That was given by some other ministry. So then the RBI has to, or the Ministry of Finance has to interact with those ministries. So you assume, every time people assume that if there is an interpretation issue, RBI will have a final word. They will not have a final word on interpretation of FEMA. Interpretation of FEMA will be left to the judicial process of the law. So therefore, it is very unwise to say that everything RBI has a solution. RBI does not have a solution for everything, And there are very little judicial precedents. So if you today talk about FEMA and case laws, I don't think there are more than 200 to 500 case laws in the 25 years in the public domain. So it's a very, as compared to income tax where there are 500 cases every day, this is total 25 years, you have only about 100 to 200 or maybe 500 cases max, if at all they have came out. The reported one could be still lower, possibly. And these past compounding orders are available on the RBI website. So whenever you have time, please open those orders and see what was the facts of that case, what was the contravention, how it was compounded, what was the client or what was the company said about why it chose a particular interpretation. So after a certain point in time, compounding orders were stopped being published on the RBI website, but there are some old orders available and they still give you a very good guidance. In fact, there is one book which is written by one author, and it is a compilation of all compounding orders. So you can in fact buy that book and you go through that as well. And as I said, RBI has implemented late submission fees for most procedural default, which is a very good thing. So don't go for compounding. Don't wait for penalty. If something is late, pay the late submission fee and move on in life. Now, in terms of research material, reading material, RBI website, as I'm trying to tell you, is perhaps one of the best website. I don't know, I may not be online here, but I can otherwise show you how the RBI operates. There is a home button, and within that, there is a function-wise RBI website. In the function-wise RBI website, you just go to Foreign Exchange Management Act. Then there are two books that I would recommend. The Taxman Manual on FEMA is really good. It is in 2 volumes. One is the statute and one is a commentary. Commentary you can ignore, but the statute book is superb. And there is one book on treatise on FEMA, which is authored by a very senior FEMA practitioner, Dr. Dilip Seth. So this is one of the most authoritative commentary on FEMA, and I can say it is either the Palkhiwala of FEMA or the Sampath Iyengar of FEMA or the Chaturvedi and Asha of FEMA. So this is one of the best book on the FEMA. Or you have like Pithisaria under the Companies Act. This is one of the best book in terms of issues under FEMA and the case laws and the interpretation that are surrounding various FEMA topics, Lastly, I think, things to watch out for. So the finance minister has announced a comprehensive review and overhaul of FEMA in the speech of Union Budget 2026. So friends, the belief is FEMA is now about 25, 26 years old, and it still is not meeting the requirements of the modern day and world. So there is a work that is going on in sort of rewriting some of these acts, like how the new Income Tax Act came in from 61 to 2025. You have the new Companies Act that came in. You have the new GST that came in. Government wants to bring in a new FEMA law. We'll have to wait and watch how the law is going to take shape, but that's certainly on the anvil as of now. Similarly, some of the rules and regulations are also being liberalized, like non-debt instrument rule. It is that rule has almost 11 schedules. And you have to, categorize foreign investment into 11 baskets of, you have to choose between where you fall. So again, they're trying to simplify it as much as possible, simplify the filing, simplify the compliances, because some of the filings, like including valuation report, giving this certificate, that certificate, all of these are very onerous and time consuming, Then as I mentioned earlier, there are new import and export regulations that have come in from 1st October 2026. These are again going to create a lot of challenge to the banks, to clients, because everything is now going to get recorded except when it is a very low threshold. So I think it is important that we are already in April. I think it is important for practitioners to go through that, see the impact on the exports of, let's say, specifically the service industry or chartered accountants, lawyers who receive money in foreign exchange from foreign clients. How is it going to impact them? I think most of us are not even aware that there is going to be some reporting that is going to hit us in October. So please go through that. And including, I hope, in the session on import and export, it is dealt with adequately, but it is one of the most important and fundamental change that is going to come in from 1st October 2026. And I cannot but tell you how busy we are all going to be in October 2026. And the new law is going to come in October only, one of your busiest season. So if you've not taken time out to study it today, it's going to be a race against time in October 26, Then in the union budget speech, the finance minister had announced that it will allow foreign citizens and individuals to do portfolio investment. Today, you can come and today a non-resident can invest on the Indian stock market only under the registered foreign portfolio investor routes. So that route is a very complicated route because it requires registration with SEBI, approval from a depository and stuff like that, custodian and all that. So they are trying to again simplify that law because stock market again has been dwindling a little bit. So they want a little bit of more buoyancy to return. So now they are wanting to allow all foreign citizens to invest. So it's like you invest in stock market, even they'll be able to invest in stock market. They'll be allowed bank accounts. So a lot more opportunity is going to be open up on that front. So that schedule is not yet out and the modalities are not yet out. But I think as and when it comes out, again, it will be a very big opportunity for professional. And then again, there is some arbitrage between FEMA and GIFT, IFSC. Somebody here mentioned about IFSC. So IFSC indirectly allows you to do a lot of things which FEMA does not allow you to do directly. The authorities are aware about that. Some leverage is allowed as of today. So as you learn the subject a little bit more in detail, some level of arbitrage is available, and those who are wanting to take that arbitrage are taking that arbitrage. But I think overall the government wants to rationalize GIFT and FEMA in such a way that it is a win-win for the investors, the government, as well as you don't defeat the purpose of FEMA. So I think there is a little bit of alignment required. Some alignment has already happened. You have an RBI representative already a part of the IFSC authority. So to that extent, there is a representation of RBI and IFSC, not that what is happening in IFSC is not to the knowledge of the RBI. But there is a lot more that needs to be happening around that topic, and we will have to wait and watch as to how this subject evolves. And lastly, as I mentioned, that many reporting under FEMA are still very onerous, and therefore a lot of representation has been made by various stakeholders, including professional bodies, including industry bodies, including large companies, to simplify some of these reporting simplification or digitalize it or allow them to access. Like even simple like IDPMS, EDPMS, you don't have access. You have to depend on the bank to give you a database. If it is my data of export, why am I not allowed to have direct access? So some of these reporting and compliance implementation should be simplified in due course, and that is a work in progress from the perspective of the regulator. So this is something that we all need to watch out for. So I think that's it from my side. I think dot on time, and we still have about maybe 5-10 minutes for Q&A. If anybody has any questions, I'm happy to take it. I hope I've been able to add a little bit of knowledge to whatever you didn't know. I enjoyed speaking here, and I'm open to questions. Thank you so much.
From the foreign clients. I have some of the clients who pay me in my PayPal account, and which is linked with my Indian bank account, and I finally receive the fees in INR in my Indian bank account after conversion. And some of the clients pay me directly in INR through their NR or NRI account. So what are my obligations in that scenario? If you could please throw some light on that.
So I think I would say you raise it in the export session. That is better. But I think, according to me, PayPal is an authorized OPGSP, online payment gateway, and there are rules surrounding up to certain amounts which can come through that account. So if you're falling within that rule, because so long as the bank is issuing you an FIRC, that is not a problem. If you get an FIRC, the thumb rule is everything is okay. Otherwise, the bank will not give you FIRC. Your recipient bank, if it gives you FIRC, that means the payment has come in through the right channel. And so far as transaction with NRIs are concerned, you can receive from NR also or NRE also. Both are fine. That is not a problem.
Thank you, sir.
That is permitted. Because in both the schedule, you can make local payment. Local payment is allowed. But for OPGSP like PayPal and all, it is a little bit complicated. But I generally advise my client, if you are getting an FIRC, because you will need it for GST purpose as well, right? So if you are getting an FIRC, it is okay. You don't have to understand behind what is going on. Okay. But there are detailed guidelines, and there are OPGSP guidelines specifically issued by the RBI. You can refer that as well.
Okay. Thank you, sir.
I have receivable and payable from same foreign vendor. And for commercial reasons, it is better to offset it. Is it allowed?
Yeah, it is allowed. It is allowed. But there are terms and conditions.
Yeah.
The terms and conditions are friendly, not very friendly, depending on your case. Under the new law that is coming from 1st October, it is very friendly. But as of now, it is allowed. It is goods to goods, services to services, same calendar year. Some provisions are there. So if you satisfy those provisions, set-off will be allowed. Yes. No, that is allowed. That is going to be allowed. It was not allowed earlier. It was then allowed for SEZ. Now it is December 2020 is when this law was liberalized, and currently there is a direct provision on that. So you refer to the master directions on import-export, you will get these provisions.
Sir, so can you throw some more light on the regulation regarding the reporting of export of services coming from October 26?
So that will come in the new export. There is an export session, no? I think you can please pick it.
That will be covered in the export session. Okay.
Because that's just a reporting. So it's something you can pick it up there, Yes, there was someone else over here. I don't know.
Bank doesn't allow you to proceed with a certain transaction because of their own mindset on that topic, or say own conservation on that particular transaction, where we should approach with and how, means if at all you could give some idea.
So very good question. I think if there is a law that is subject to self-interpretation, I think every person may take a different view, and I've seen bankers also taking a differing view. But let's say if the banker is not agreeing to the view, I think what we have offered to them is three things. One is give them an opinion of an expert. And many times after taking an opinion of an expert, which could be, lawyer, someone like us, they have changed their view. I've seen them changing their view. They go to their legal team, their compliance team, and they've changed their view. Second option is they can go and check informally with the RBI, whether the view they are taking is correct or no. So many times they consult with RBI, and if the RBI says, no, your view is incorrect, they have changed their view. The third is, if it is not getting resolved by these two steps also, for example, then you will have to apply to the RBI, say that this is the view the banker is taking, this is the view which the client wants to take, and please guide or give the approval or the clarification. And the RBI has then given a formal clarification as well. So under the Prava portal, you can apply to RBI and take a clarification and proceed.
Thank you, sir.
Sorry? So that is my guess versus mine. I've seen clarification coming in one day. I've seen clarification taking 6 months also. But generally about 4 to 8 weeks, But I've seen quick clarification also. I've seen 24 hours also RBI has reverted. RBI has reverted in 3 days also, 7 days also, 15 days also, 1 month also. See, it depends on the issue, depends on the timing of your application, everything, But there is RBI has a charter of duties or something where they say they will revert within 1 month or so. But generally it happens between 4 to 8 weeks, by and large, unless you are very unlucky. I have seen now the bankers take 4 weeks to file or 8 weeks to file, and then RBI reverts faster, So it's the other way around now, So those who may have experienced it, earlier the RBI used to take a lot of time, the banker used to file it in 1 day, 2 days, now it's the other way around, All right, any other question? Okay, if there are no questions, then let me thank you once again, and I wish you the very best for your forthcoming session. Have a great learning on FEMA. Thank you so much, and look forward to meeting you sometime in future as well. Thank you.
Thank you, Shabbir bhai. I think the entire session was very interactive, and everybody enjoyed it a lot. And I'm so confident that it has set the right tone for the entire series. And everybody is looking forward for the coming session to deep dive into an ocean, which is literally so enchanting and so interactive. Thank you once again. Now I would like to invite Rajveer Majmudar, Yashpal Singh Jadeja, and Jayant Talota on the stage. They are from ICICI Bank and they would like to share some insights on the topic.
Hi, good morning. So, good to see you, all of you. So, as ma'am introduced, we are from ICICI Bank and we thank Rinkesh ji and ICAI for giving us this opportunity to get associated with this FEMA series. And Shabbir ji, it was an honor to hear you in person. Of course, we are in touch with leading consultants on FEMA. So, very quickly, so 2-3 things as Shabbir sir also mentioned. Our role as a AD, we always try to ensure that we are on right side of compliance. Few things my colleagues will take you through, but my only request to all of you is that in any cases that you come across of your clients, where we need to play a role of a mediator or a role of a person who actually interacts with not only your client, clients, consultants, which might be you, investor also, who might be overseas investor in case of FDI, overseas investors, consultants also, we all come together on a platform like Teams. We try and understand the structure, and if required, we even go to regulator to seek clarity if this structure is as per FEMA guidelines. In fact, in some cases, rare cases, where it was required that we get in touch with RBI to seek quick clarity whether this structure can go through or not, we have done that also. So my humble submission is, in fact, if I talk about Ahmedabad market, in last 1.5 years, all the leading capital account transaction deals which have happened, I'm proud to say that ICICI Bank has played a significant role in ensuring that this transaction gets through within timelines and as per compliance. My humble submission to you is that any case where you feel that you need AD Bank's view, or you need to take some clarity from RBI, we'll be more than happy to help. I'll request Jayant and Yashpal ji to take you through a few slides on what we actually do as ICICI Bank AD and how we try and ensure that there is ease of doing business as far as FEMA related compliance is concerned. Over to you, Jayant.
Yeah, very good morning. So couple of things. I mean, in the session we got a really good insight on the FEMA part. So as a bank, I mean, as a AD bank, the RBI has given us the the authority and the responsibility both, right? So we try to play the role wherein we are on the compliance part. We try to ensure that the FEMA compliance is being ensured. At the same time, the convenience to our customers, how we can add to it by way of our platforms, the understanding of and the interpretation of the FEMA, right? So the cross-border transactions, the current account and the capital account transactions, both on both the sides, we have tried to create our platforms, right? So today we are trying to showcase the capital account transactions, how we are approaching it, how we are adding value to our customers, and how we are doing it. That's we are trying to showcase. Yeah, thank you.
Good morning to everyone, and thanks to Rinkesh sir for giving such opportunity to be with you. So like Shabbir sir has taken this FEMA session. So what we understood as a AD, there was a question raised that being a CA and client and AD bank, if three are having a helping hand, so client is also happy, bank for compliance perspective, and being a chartered accountant, that your clients are meeting all compliance requirement where there is no LSF, no compounding. So such thing will play a good role synergies. So what you can consider as a helping hand in your day-to-day routine transaction like capital account, current account. So first, you have connected with your client. They might be saying that we are getting the FDIs, but the funds are not settled on a same day. So ICICI Bank client can settle their inward through online, and in a single day they can settle the fund. So we have arranged whenever the client initiate the fund, so we will guide them that you have to put two details in your SWIFT KYC, their registration number, and since how long they are banking. If the details are available, the fund gets settled in a single day. Initiation of FDI ODI transaction online. So as I said, FDI can be settled online, even though ODI, except resident Indian, body corporates can initiate their transaction through trade online. And we have seen that promoters, MDs, CFOs are traveling frequently. So digital signature is also acceptable. So transaction can be processed on a same day also. You can initiate the transaction for FDI ODI. Online compliance dashboard and frequent pendency. So client will get the dashboard in their trade online that how much this bill of entry, EDPMS, IDPMS, apart from that their APR, regulatory reportings are pending. So they get the reminders mail, and on dashboard they can see that how much pendencies are currently in the company. Now most important, client has received the FDI. Later on when you're filing all 9 reportings, sir has displayed that forms portal, 9 reportings. So there is a case of convertible notes. There is a case of FCTRS. So as ICICI Bank, you can use our pre-waiting portal for getting the documents verified on the ICICI Bank portal. So this is a helping hand where whenever you file and filing on pre-waiting, you get 100% idea that any rejection is there or any document has been missed out or required correction. So to avoid multiple rejection, a single approval you can get it in a firms by filing or getting verification in pre-waiting portal. And there are cases, we have seen that automatic route cases are you can say very straightforward, like that transaction get processed. But sometimes client business on a different level where multiple things are involved, regulations, compliance, taxation. So kind of cases where require the view of RBI along with AD, CA and client, we can present the case in RBI also. And there was a question that AD board policy, apart from that opinion. So we have seen when we have received the opinion from the client and CA jointly with internal policy, we have also refer in RBI, and we have seen that regulation was also amended in such scenarios. So comprehensive guidelines on FDI and ODI transaction. So in our stall, we have put it the FDI, ODI and trade this leaflets. So request whenever you visit the stall, you get that.
क्या होता है कि when you are dealing with some large value deals and the transaction is very very sensitive and time bound in nature, ये एक बहुत बड़ा peace of mind है अगर आपको pre-vetting ये पूरा structure का हो जाता है. We as a AD bank give you in principle okay of entire structure of transaction from FEMA compliance perspective. So I think this is something which we strongly recommend to our clients, that before actually executing any transaction, it is always good to have this peace of mind that transaction is compliant with FEMA guidelines. So please come back to us if you have any particular deal or client in mind. We'll be more than happy to get associated. Thank you so much.
Thank you so much. I'm sure many of us have so many questions whenever we deal with clients who are into FEMA, and I'm sure ICICI Bank will be one of the go-to banks for us. Now I would like to invite Jai Joshi to just provide us the vote of thanks.
To giving vote of thanks to the Shabbir sir, it is not an easy task, but it is a thank you Shabbir sir for enlightening us on the first session of the FEMA series. We have touch base upon the so many aspects like the definition under the various definition under the FEMA. Second is the import and export guidelines. Third is the key your presentation highlights the key point you have mentioned about that. Then the thumb rules which we have true on the capital and current accounts and so on. And the last but not the least is the do's and don'ts for the FEMA who are doing the started practice on the FEMA. So on the behalf of ICAI Ahmedabad branch, we thank you all from this session, sir.